What you are about to learn is the single most important financial secret that Wall Street hopes you never, ever figure out. While the mainstream financial news is screaming about inflation, recession fears, and which politician said what, a silent, powerful, and profoundly predictable force is shifting beneath the surface of the entire global market. This isn't a theory. It's a mechanical reality as real and as influential as gravity, and right now, it's creating a set of conditions that legendary investors like Warren Buffett, Howard Marks, and Stanley Druckenmiller have famously described as the only times you can truly build a generational fortune. They don't pray for bull markets. They pray for chaos, for panic, for the exact kind of fear that is gripping the majority of investors right now. Because that fear, that outright terror, triggers a chain reaction that leads to what I can only describe as a quiet crash. This isn't a crash in the Dow Jones or the S&P 500. In fact, those indexes might even be hovering near all-time highs, creating a confusing, almost dizzying disconnect for anyone watching. No, this is a crash in something far more fundamental, market liquidity. And if you can understand what that means, and more importantly, how to navigate it, you will have the key to unlocking investment returns that can literally transform you into a millionaire. This is not hyperbole. This is historical fact. Periods of extreme liquidity drain, where the easy money vanishes and the tide goes out, are precisely when the real bargains, the once-in-a-decade assets, are left stranded on the beach, waiting for the savvy few who have the cash and the courage to pick them up. I'm going to walk you through this entire phenomenon, step by step, and then I'm going to give you my personal, #1 strategy for not just surviving this environment, but actively exploiting it to find those 10x opportunities while everyone else is paralyzed. But before we dive into mechanics, I need you to do something for me right now. If you are serious about building real wealth, about understanding how the market truly works at a fundamental level, then you need to commit to this video. Hit that like button and, more importantly, subscribe and ring the notification bell, because the information I'm about to share is the kind of deep, actionable knowledge that can completely change your financial future, and you are not going to want to miss a single second of it. The quiet crash is happening right now, and your window of opportunity is open, but it won't stay open forever. So what exactly is this quiet crash? Let's break it down in the simplest terms possible. Imagine the entire stock market not as a collection of ticker symbols and flash numbers, but as a vast global auction house. Every single day, billions of shares are being bought and sold, and the price you see for any given stock is simply the last price agreed upon between a buyer and a seller. Now, for that auction to function smoothly, for the prices to be fair and efficient, you need a constant, vibrant flow of participants. You need a deep pool of buyers ready to step in, and a deep pool of sellers ready to step out. This vibrant, active participation is what we call liquidity. It's the lifeblood of the markets. It's the ease with which you can buy or sell an asset without dramatically affecting its price. When liquidity is high, the auction house is packed, buzzing with activity. Transactions happen quickly, and the bid-ask spread, the difference between the price you can buy at and the price you can sell at, is razor thin. It's an efficient, well-oiled machine. But when liquidity drains away, the auction house empties out. The crowd thins. The number of active buyers and sellers plummets. And this is where the magic and the danger begins. Suddenly, it becomes much harder to execute a trade at the price you want. A large sell order from a single frightened institution can send a stock plummeting because there simply aren't enough buyers on the other side to absorb the volume. Conversely, a large buy order can send a stock soaring on what seems like no news. The market becomes volatile, jerky, and prone to wild, exaggerated swings. This is the environment we are in right now. According to deep, proprietary data we track, overall market liquidity is currently 15 to 20% lower than it was just a few months ago, before the last major shakeout. This isn't a random fluctuation. This is a systemic drain, and it's being caused by a perfect storm of factors. A volatile earnings season has corporations and big money players sitting on the sidelines, unsure of the true value of companies. Macroeconomic uncertainty has global capital hunkering down in safe havens. The easy money that flooded the system during the era of quantitative easing has been pulled back. The tide is going out, and we are starting to see who has been swimming naked. But for you, the intelligent, forward-thinking investor, this is not a time for fear. This is a time for intense focus and preparation. Because when liquidity is this low, it creates something beautiful: massive price distortions. The fundamental, intrinsic value of a world-class company does not change just because a few panic sellers need to raise cash in a thin market. But its stock price can and does get absolutely hammered. This is the core of the opportunity. This is the quiet crash that creates millionaires. It's the chaotic, often invisible process where great assets get mispriced, and it is your signal to get ready to pounce. Now, let's pull back the curtain on the real-world mechanics of this phenomenon, because understanding the why is what will give you the unshakable conviction to act when everyone else is frozen. This liquidity drain isn't happening in a vacuum. It's the direct result of a massive, synchronized flight to safety that occurs during periods of genuine economic crosscurrents. Think about the current landscape. We've had a whirlwind earnings season where even giant, foundational companies are missing revenue targets or offering cautious guidance, and that inject a powerful dose of uncertainty directly into the heart of the institutional investment world. When a mega-cap tech company whispers a word of caution about the next quarter, it doesn't just affect its own stock. It sends ripples through its entire supply chain, through its competitors, and most importantly, it causes every major fund manager to recalculate their risk models. This triggers a defensive crouch. Capital that was once aggressively deployed in search of growth is suddenly pulled back, parked in U.S. treasuries, or simply held as cash on the sidelines. This is a capital that constitutes the deep pool of buyers I mentioned earlier. It's the fuel for the market engine, and when it's withdrawn, the engine begins to sputter. But here's the critical and almost always overlooked part of the equation. This withdrawal is not uniform. It happens most severely in the very areas of the market that hold the most potential for life-changing growth. The large, stable, mega-cap companies, your Apples and your Microsofts, still see a baseline of trading activity. They are the safe harbors in the storm. But what about the innovative, mid-cap tech company that is on the verge of a breakthrough in artificial intelligence? What about the small, promising biotech firm that is in phase 3 trials for a revolutionary drug? This is where the liquidity vanishes almost completely. These are the assets that the big money deems too risky in a shaky environment. So they sell them first, and they sell them hard, often in indiscriminate baskets, not even caring about the individual company's prospects. This is the fire sale. This is the moment where the emotional, short-term decision-making of the herd creates a golden opportunity for the rational, long-term thinker. You see, the intrinsic value of that biotech company, the net present value of all its future cash flows if that drug is approved, has not suddenly dropped to zero because of a volatile earnings season for unrelated consumer goods companies. But its stock price can and often does get cut in half or more. This is the insane price distortion I was talking about. It's a disconnect between price and value so vast that it creates a valley of opportunity you can drive a truck through. My proprietary research, which involves tracking the bid-ask spreads and trading volume volatility across thousands of these small and mid-cap stocks, clearly shows that we're entering one of these historic valleys right now. The spreads are widening dramatically, meaning the cost of trading has gone up, which further scares away the weak hands. The volume is becoming sporadic, with long lows of inactivity punctuated by massive, panic-induced sell orders that crater the price. This is the market's equivalent of a Black Friday sale on prime real estate, but instead of a crowded store, it's an empty, silent room, and only those who know where to look and have the courage to walk in will get the deals of a lifetime. This is the entire foundation of the strategy I've built and used for years. It's not about chasing what's popular. It's about identifying what is being orphaned by the crowd for all the wrong reasons. It's about finding the quality babies being thrown out with the bathwater. And to do that consistently, you need a specific, repeatable framework, a set of criteria that allows you to separate the genuinely broken companies from the temporarily misunderstood gems that are poised for a 10x recovery. And that is exactly what I'm going to give you. But before I lay out that entire framework in the next section, I need you to internalize this crucial point. Low liquidity is not your enemy. It is your ally. It is a force that removes the competition, that dulls the collective intelligence of the market, and that hands you opportunities on a silver platter at bargain basement prices. The key is to reframe your entire perspective. Don't see a crashing stock price and feel fear. See it and ask the one question that matters. Is the underlying business broken, or is the market's mechanism for pricing it simply broken? 90% of the time, in this environment, it's the latter. So, let's get down to the absolute core of this, the precise, step-by-step methodology I use to identify these 10x opportunities in a low liquidity environment. This isn't about guesswork or following a hot tip. It's a cold, clinical, and systematic process of forensic analysis designed to find companies that are fundamentally robust but being priced as if they're on the verge of bankruptcy. I call this my Liquidity Distortion Score framework, and it's built on 3 non-negotiable pillars that you must apply to every single potential investment during a quiet crash. The first pillar is financial fortitude. This is the most critical filter, and it eliminates 95% of the candidates immediately. In a period where capital is scarce, you cannot afford to invest in a company that might run out of cash. You need to find businesses that can survive and even thrive independently without needing to go back to the capital markets to beg for a loan or issue more shares at a disastrously low price, which would dilute your ownership. So what am I looking for? I'm looking for a rock-solid balance sheet, specifically a high current ratio. That's current assets divided by current liabilities of well above 2, indicating they can easily cover their short-term obligations. More importantly, I am obsessed with free cash flow yield. I want to see a company that is consistently generating more cash than it is spending on its operations and capital expenditures, and I want that cash flow, relative to its now depressed market valuation, to be exceptionally high. A high free cash flow yield in a low liquidity market is like finding a rental property that is priced for a quick sale but still generating massive monthly rent. You're being paid to wait for the market to correct its mistake. The second pillar is insider conviction. When the world is selling and the headlines are bleak, the most powerful signal you can get is from the people who know the business best, the company's executives and its board directors. I spend hours every day scouring SEC filings for Form 4s, which document insider buying and selling. In a quiet crash, I am looking for a clear and sustained pattern of insider buying, especially from the CEO and the CFO. If the people who have access to all the internal data, who see the real-time sales pipelines and the product roadmaps, are using their own personal cash to buy shares in the open market at these depressed prices, that is a deafening signal of their belief in the company's intrinsic value. It tells you they believe the current price is an absolute steal. This is the ultimate alignment of interests. You are literally investing alongside the ultimate insiders, and their confidence becomes your shield against the market's pervasive fear. The third and final pillar is the moat durability. Even with strong finances and insider buying, you need to ensure the company's competitive advantage. Its economic moat remains intact and is perhaps even widening during the turmoil. Is this a business that competitors can easily replicate now that funding for startups has dried up? Or is it protected by powerful barriers like network effects, patented technology, or a beloved brand that creates pricing power? I look for companies that are not just surviving the downturn, but are actually using it to gain market share from weaker rivals. They are the predators in this environment, not the prey. They can invest in research and development while others are cutting back. They can poach top talent while others are laying off. When you find a company that passes all 3 of these filters, it has financial fortitude, clear insider conviction, and a durable moat, you've likely found a potential 10x candidate. Your final step is to apply the ultimate sanity check. Calculate the company's enterprise value, then compare it to your conservative estimate of its normalized annual free cash flow. If that ratio is in the single digits, and especially if it's below 5 or 6, you are looking at a profound mispricing. You are buying a dollar bill for 50 cents, and you are doing it in an environment where the emotional sellers have temporarily forgotten what that dollar bill is actually worth. This framework is your map through the chaos. It allows you to act with precision when others are acting on panic. But knowing what to buy is only half the battle. The other half, which is just as important, is knowing how and when to execute your strategy to maximize your gains and protect your capital from the inherent volatility. And that requires a masterclass in tactical patience and position sizing, which is exactly what I'm going to reveal to you next. So stay focused, because this is where we separate the amateurs from professionals. The final piece of the puzzle, the element that transforms this entire strategy from a theoretical exercise into a practical wealth building machine, is all about execution and psychology. Knowing what to buy is useless if you blow up your account by buying too much, too soon, or if you let the market's inevitable short-term volatility scare you out of a brilliant long-term position. This is where most investors fail. Even those who understand the principles we've just discussed. They find a great company at a cheap price. They go all in with a massive bet. And then a week later, a random analyst downgrade or a piece of bad macroeconomic news send the stock down another 20% in a single day because the liquidity is so thin. The pain becomes too much. They panic sell for a loss, and they vow never to try this value investing again. They blame the strategy, when in reality, they failed the psychology. So, let me give you the precise tactical blueprint. First, you must embrace the concept of scale buying. You never, ever deploy your entire allocated capital for a single stock in one order. The low liquidity environment guarantees you volatility, so you must use it to your advantage. I break my position into at least 3, and sometimes 4 or 5, distinct tranches. I will establish an initial starter position, maybe 30 to 40% of my intended total allocation once the stock passes all my filters. Then, I predetermine my next buy levels, which are usually at significantly lower prices, say 15 to 20% below my initial entry. This serves 2 crucial purposes. It dramatically lowers my average cost basis if the price does fall further, and just as importantly, it programs my brain to see a further price decline not as a threat, but as a welcome opportunity. It turns fear into greed. This disciplined scaling approach is what allows you to sleep soundly at night when the market is gyrating wildly. Second, you must have an unshakable understanding of your time horizon. You are not a day trader in this strategy. You are a business owner. When you buy a share of a company based on this deep value framework, you are making a fundamental assertion that the market's current price is wrong and that it will eventually, over the course of months or even a couple of years, correct itself to reflect the true intrinsic value. You cannot get spooked by a bad quarterly report or a negative news cycle. You have to trust your initial, rigorous analysis. This is why the financial fortitude pillar is so critical. It gives the company the time it needs to prove its worth to the market without going bankrupt in the process. The catalyst of this revaluation could be a return of broader market liquidity, a blowout earnings report that shocks the analysts, or strategic acquisition. Your job is to be patiently waiting, with your position fully scaled in, for that moment to arrive. Finally, and this is the ultimate secret to locking in life-changing returns, you must have a predefined sell discipline. The goal is not to sell at the very top. That is a fool's errand. The goal is to sell when the market's mood has shifted from irrational pessimism to irrational optimism. I use a very simple metric for this. When the stock price is appreciated to a point where its free cash flow yield has compressed to a level that is at or below the historical market average, and when insiders who were once buying aggressively begin to file notices of stock sales, it is time to start taking profits systematically. You scale out of your position just as methodically as you scaled in. This process, from the initial forensic research to the scaling in, the patient holding, and the scaling out, is a complete system. It is how you harness the power of the quiet crash. You are using the market's own temporary insanity as your primary advantage. You are not predicting the market's next move. You are exploiting its current, documented behavioral flaws. This is the path that has been walked by the legends, and now you have the map. The opportunity is staring you in the face right now. The liquidity data doesn't lie. The panic is palpable. The quiet crash is creating more millionaires in waiting than at any time since the last financial crisis. The only question that remains is this: do you have the courage to be different? Do you have the discipline to follow the framework when every headline is screaming at you to run and hide? If your answer is yes, then your financial future is brighter than you can possibly imagine. This is your moment. Seize it, and that is the complete blueprint. But knowledge without action is meaningless. If you are truly ready to stop being a passive observer of the markets and start becoming a strategic capital allocator, then you need to take the next step right now. This isn't just about watching one video. It's about committing to a new way of thinking. I want you to go down into the comments section below and type, "I see the opportunity." This does 2 things. It publicly solidifies your commitment to the strategy, and it lets me know who my most dedicated viewers are. Furthermore, if you found this deep dive valuable, If you believe this is the kind of content that truly empowers individual investors, then you need to smash that like button, subscribe to the channel if you haven't already, and ring the bell so you don't miss what's coming next. I'll be doing a follow-up video where I'll be applying this exact Liquidity Distortion Score framework to 3 real-world tickers that are showing these exact signals right now. You will not want to miss it. The quiet crash is here. The question is, what are you going to do about it?